our questions first via email. Don sent an email earlier today, a question for today's webinar. In this social, economic, and political environment, what process are you following to develop a strategic and tactical portfolio? How are you protecting it against current and unexpected volatility? It's a question that's probably on a lot of people's minds in one way or the other. This is very similar to a question I received from Maurice earlier this morning. He said, with the presidential election coming soon, is there a strategy to protect a portfolio and where the protection should be applied to the entire portfolio, including cash, or just to the equity portion as well? How long should protection be in place in reference to the election? Okay. This doesn't really relate to William's question, but William's question is more specific to a certain aspect. But let's get on to answering Don and Maurice almost in one. First, let's talk about what we've seen the last few weeks. The top chart over there on your right-hand side is SPY over the last 3 weeks, starting at around, end of August. What we're looking at here is that September 2nd high, and then the fall that started on or around September 3rd. During this time, SPY dropped from a high of about 359 to a low of about 320. So we're looking at a drop of minus 10.8% from the ultimate high to the ultimate low. That's really from September 2nd to that low there, it looks like on the 24th, the other day, excuse me. Now, from the very high to the end of today, the market closed at around 330, 329 is where I saw it when I was looking earlier. Might have dropped a little bit lower at the end, I'm not sure. But anyway, we're roughly down 8.1%. Now, during that same period, the VIX, the volatility index in UVXY, but the VIX itself was a low of 26 and it gapped up to a high of 38. It's a rise of almost 50%. And it gained about 12 points starting at 26. But that happened in a 2-day period. And really on the day that it jumped up there, I think it happened in about a 2-hour period. And as of the close of today, or near the close of the day, we're about 2650, 2670. So we're right about where we started at the market high on September 2nd. Now we know the value of VIX calls is different. It's not based on the underlying per se. It's your calls or your puts may not have exact intrinsic value on the VIX. It's based on those futures and the projection of volatility into the future. So why am I bringing all this up? A couple of weeks ago, we posted the discussion from our Friday presentation, hedging leveraged positions in your portfolio. Okay, you can see the YouTube link there. You can just go to our YouTube channel and look up hedging leveraged positions. We can go to the options concepts category on the Power Options webinars page. In the first 20 minutes of that presentation, we took a look at a portfolio of about 5 or 6 long call positions, bought calls, and how they fared roughly the first few days of the decline. Say they were purchased at the end of August or beginning of September. What hedges might we have done? Well, we might have bought VIX calls. We might have bought puts on SPY, or we might have bought shares on UVXY directly, a volatility ETF directly, to hedge against fear of volatility, fear of those sudden declines that we did see on around September 4th, September 3rd, of course. Now, the SPY puts on that day, when we evaluated this on September, that Friday discussion near the end of September, that September 8th, end of that week, the SPY puts had worked the best. And that's due to the fact that it was a general decline, a gradual decline over a few days, just like it's been a gradual decline mostly since September 3rd to today, the 25th. So broad market indicators, SPY, QQQ, IWM, which we might talk about in a moment, those actually, using those as a market hedge, a portfolio hedge, whether you're in long stocks, whether you're looking to hedge a leverage portion of your portfolio, say spread positions, bullish spreads, or even bought calls, which we were analyzing in this webinar, in a gradual decline that is consistently going down over an extended period, yes, the volatility might be moving up, but it's not spiking as we saw back in March of 2020, from February 25th to March of 2020, when it was up near 85 and 90. We're not looking at that. Okay, this is more of a gradual decline and a gradual pullback. Those of us that are bullish and in bullish positions, we don't like to see it either, but that's the case. Trading UVXY and the VIX as a hedge, you'd have to catch it very quickly. Sell half of that portion that you purchased on the spikes. Sorry, I didn't realize my little arrow was still up there. To get the max benefit of that type of hedge. So, just a view. Right before we started the webinar, I took a screenshot from our webinars page where we were tracking those positions in the portfolio against the long puts and against a bull put credit spread portfolio. And you can see the results here. We would have bought UVXY, roughly 20 shares or so, to keep the monetary amount the same as a comparison to hedge the long call portion of the portfolio or bullish portion, calendar spreads, bull put spreads. Well, those 20 shares of UVXY are down 8.6%. Right, we purchased them at about $22.65. UVXY was around $20.70 near the close of today. There was a small profit on the shares of UVXY on around September 4th and 5th with that spike in volatility. But you saw from those profit and loss charts, the graph, of SPY versus VIX, how quickly that evaporated. The VIX long calls, they're down about 87%. Buying the September 30 strike calls, when the VIX was around 25, I believe, on, again, August 31st, paid $370. They had a profit at one point at the highest peak, and another little profit further on, later on during September. But as a consistent hedge, it's really far down now. It's not helping the further decline of those bullish positions, those leveraged portions of our portfolio. What's doing the best so far, even though it's only 5 days to expiration? August 31st, buying a 1 month out SPY put, the quarterly that ends on September 30th. It's up 87%. Now, this is not a huge gain, okay? I mean, because we only viewed one contract to keep the monetary investment close to the same of these three positions. But because it has been a gradual decline, and it hasn't been spiking severely with the VIX, this gives us a better hedge on the position that we were evaluating. Okay, so let's go on now. What Don really asked was setting up a strategic portfolio to protect against the spikes in volatility, the uncertainty of the election coming up. And many of you have heard me say, you can go back through the webinars on YouTube and other times as well, and you've heard me say since several years ago that at any given time, about 50 to 60% of my portfolio is in the radioactive trading married puts or collar positions. Maybe 10 to 15% of my portfolio is in bull put credit spreads. 5 to 10% might be in diagonal calendar spreads, mostly calendar call spreads. And I'll take maybe 5% or so to place straddles on earnings or have a strangle on SPY, also potentially as a hedge. But then 2 to 3% of that total portfolio is going to be a hedge, not for what I'm tracking in the married puts and the collars. I'm not worried about protecting those because they're already protected. What I'm trying to protect is the loss on the leveraged portion of my portfolio. Long calls, which could lose 100% of their value in a decline that we've seen in the past 3 weeks. Bull put credit spreads, which could see a 100% loss of what you put into the positions in the case of a 10, 12, 15% decline that we've seen in the last 3 weeks. Iron condors, of course, would take a loss to the bull put side as well. You know, if you're doing bull call debit spreads, you might be near that 100% loss also. That, in my opinion, is what I'm looking to hedge. I'm not trying to reconstruct my entire portfolio for fear of what's coming forward. I have ways to manage the married puts. I have ways to manage the bull puts if they start to go against me. But if I'm concerned about market uncertainty, concerned about spikes in volatility, I'm looking to hedge that portion of my portfolio. Now, trying to set up my graphics real quick before the webinar started. I know this is not the best way to show it. What you're looking at here is the top 3 bull puts that matched our bull put weekly search. If we had opened them on September 4th, if I'd run the search on September 4th when the decline started, the top 3 here, PSA, BABA, and Roku, going to the September 18th expiration, all 3 of them expired worthless for the maximum profit. Didn't need a hedge in those positions during that time frame. At some point, BABA and PSA, I believe, got close to a point where I would have managed those bull put credit spreads, but I don't think it hit all of the triggers I would look, and that's for a different discussion. We've had a couple of those discussions last week. But on September 4th, the bull put spreads going to September 18th, roughly 14 days away, all of the top 15 results that matched that criteria would have expired worthless to an average of 14.2% return, while QQQ was down 6.3% and SPX was down 3.2%. But we saw the highs and the lows, where of course SPX was down about 10.8%. That summary here is related to the bull puts that matched this criteria on September 4th for September 18th expiration. Down at the very bottom, and I apologize if you can't see it that well if it goes to the very bottom of the screen, these are the top 3 married puts that would have matched my radioactive default search on September 4th. Newmont Mining, AEM, some of you are going to go laugh at that one, and Horizon Pharmaceuticals. Now, originally would have purchased NEM at 65.35 on September 4th, and today, 9.25. We did have a good little bump up yesterday. The stock's at 61.45. Still down about 5 points, or 4 points really, but down about that 8% that we saw currently with SPY as well. The married put's only down 3.5%. AEM, 78.86. And on 9.25, it's at 78.31. I don't know if that's right. I'm going to have to look at that. We'll look at that in a moment. So this is only down 2.2% in that position, but this stock has dropped far. This stock has been down 11%. I know because I traded this as a married put earlier in September, and it was down as far as 11%, but my liquidation loss in the married put was never more than 3%, 3.5%, I believe, on the position. And I have the opportunity to use the income methods to adjust it. That relates to Emilio's question later on. And Horizon is actually showing a small profit of 1.1%. What do we know about these positions? Well, the married put is a hedge onto itself, Don. Okay, that's why it represents a larger portion of my portfolio. And if the stocks were down 10%, and I had just opened the positions a couple weeks ago, with the proper structure, puts out to March and February, a 10% decline, I might only be down, 10% decline the first couple weeks, I might only be down 2 or 3%, because I have a lot of time value. I don't need to worry about an extra hedge on those positions. What I need to focus on, if there's a 10% decline across the broad market, what do we know? Is that the bull put credit spreads, leveraged long calls, you could be looking at a 30, 40, or 50% loss on what you invested. That's what I need to hedge against with the leveraged portion of my portfolio. Yes, we know there's going to be fluxes in volatility going towards November and towards the election, as Maurice asked about. Yes, we know there's other things that are going to cause fluctuation in the markets and volatility as well. So I'm not saying necessarily it's as simple as stay the course. I know from experience, why is my portfolio, why have I been saying since 2008 and 2009 that my portfolio has been 50 to 60% married puts, some bull put credit spreads, some calendar spreads, gambling a little bit with some straddles and earnings, and then a little bit of a hedge as well, is because long term, that's what's worked best for me. That's not going to solve everyone's problems. Ernie's older than me. He's much older than me. Not much. He's not ancient, but he's older than me. He is essentially in retirement, and he just works all day to really trade his account. but he loves talking to you guys. He loves talking on the phone. He loves helping the customers at Power Options. His portfolio is almost 80% married put positions because he cannot afford wild swings in the market where he sees a 20, 30, 40% drawdown of that large amount of money. Yeah, he's still playing with long calls on the side. He's still got some calendar spreads that he's been trading recently and asking me about. That's been for about 2 months. But depending on where you are, I'm not saying that portfolio structure is best for everyone. I'm saying that this is what I know works for me. And in that light, when the trends change, I got a couple questions that came in regarding concepts of the market sentiment tool. So when I see the market sentiment tool go in a certain direction, when I see the trends change that I want, negative MACD crossover on SPY at SPX and the broad market indicators dropping below the 20-day moving average, hitting and dropping below that lower Bollinger Band, yeah, I'm going to act. I'm going to increase maybe the hedge for those bull put credit spreads in the leverage portion of my portfolio. I'm going to maybe consider starting adjusting those married put positions with an income method number 9 or an income method number 12, depending on my situation and what I'm looking to accomplish. I'm going to keep with the strategies I know and that work for me and that I already have a trading plan developed. I'm not going to bail out of my entire portfolio, all of my bullish positions, and start trading bear call credit spreads and start trading bear put debit spreads and buying long puts for high profit. Hey, you could have been successful perhaps, especially what we saw with SPY, that 87% return from August 31st till today. But remember, we see the sudden spikes down, a little bit of recovery where we would have gotten more than half of the gains we saw initially on those long puts of those bearish positions. And then yes, if we had set the time correctly, would have been farther out enough to realize some more of those profits. Yes, you should hedge the portfolio for the unexpected. We're going to talk about that in a minute from Maurice. But you don't want to hedge too much, because then you've hedged yourself out of it entirely. It's the leveraged portion that you need to worry about, in my opinion. A lot of investors will say that, well, bull put credit spreads are a low risk transaction. Long calls, buying calls, they're low risk transactions. I don't agree with that necessarily. They're known risk. The only amount you can lose on the long call is what you paid into the long call, but you're risking 100% of what you put in that position. The risk of a bull call debit spread or a bull put credit spread is known. You know the maximum loss you can take. But you can lose 100% of that if the market falls 10, 12, 15% or more. So I wouldn't say it's low risk. I'd say it's known risk. And as Sam always helps me out here in this discussion, the most important thing in any strategy is proper position sizing. That when you enter a trade, as confident as you are in the stock, as confident you are in the position, as confident as you are in your sentiment, if the unexpected happens, would you be comfortable with the loss you could take with a 10, 12, 15% movement? How would we hedge against that? But first, let's go strategy specific. If I am concerned, Don, I'm in various strategies, your portfolio is different from mine, and that's perfectly fine if you're meeting your goals. I just know what works for me and what I like to do. But if you're in covered calls and you're worried about this, consider rolling or selling deeper in the money calls for more downside while still trying to achieve your return goals. Naked puts, cash secured naked puts, a parity trade to in the money covered calls. You might want to add a put at a lower strike to create a bull put to have lower exposure. So you're not risking the full cash secured or a large amount of that full cash secured amount, even though you're 5, 6, 7% out of the money. A cheap out of the money put could free up some of that leverage and some of the exposure. Or just like the covered call, instead of going deeper in the money, look to go a little bit deeper out of the money for more protection. Iron condors, I'd manage or look to adjust the same way I would with a bull put credit spread or a bear call credit spread. Okay, I'd look for that same kind of concepts, but also if I had a portfolio, a portion of my portfolio, 10 to 15% for proper position sizing in iron condors, I'd have that market hedge in place. And if you're trading long calls, as I mentioned, if you're worried about it, convert it to a strangle. You can buy a deeper out of the money put to still keep the upside if the market still continues up, and then those sudden spikes, you've got that put there to help protect those long calls, just as you would with a long stock portfolio we'll talk about in a moment. Or you've got 10 or 12 long calls open, portion of your portfolio, 15, 20%, worried about a volatility spike, worried about a sudden downturn. Use the market hedge. Puts on SPY, puts on QQQ if your portfolio is heavy in the NASDAQ, puts on IWM, as we discussed a couple weeks ago in that webinar, the larger portion webinar. We'll talk about that in a moment very briefly as well. So that's what I would look to do. Now, to Maurice, and I'm just going to read through this. It is a bit long. My direct answer to Maurice's question was, if you have a mainly bullish portfolio, we've kind of already gone over this, but if you have a mainly bullish portfolio, you're concerned about a decline pre or post-election, thus causing an increase in volatility, well, you want something that's going to gain in your direction with that movement. Buying calls on the VIX, buying shares of a volatility ETF such as UVXY, or even buy calls on UVXY or another volatility ETF. Of course, if your portfolio is mainly bearish, you've already switched over to bear spreads perhaps, long puts maybe, calendar put spreads, things of that nature. Well, the increase in volatility due to a decline pre or post-election, that would work in your favor. Now, if you're just expecting a decline pre or post-election, you're looking to hedge a bullish portfolio where there's just stocks. Maybe you want to hedge some of the losses on covered calls. Maybe you want to hedge some of the losses, of course, bull put credit spreads or calendar spreads. As we saw in a steady and gradual decline, which we've seen, puts purchased on the broad market indicators are probably easier to manage and will work perhaps as a better hedge, depending on how your portfolio is arranged. As in, when it has a gradual and consistent decline, this may not increase the volatilities you're expecting. We saw that large spike in the volatility, UVXY and the VIX, September 3rd, September 4th. But today, it's right back down to where it was on September 2nd. It didn't work in our favor because it has been a gradual decline and a gradual sell-off. And of course, if you're playing the election and using VIX calls, puts on SPY, you're going to want to likely look for an expiration dates beyond the election. You're going to be looking at December series or January, or perhaps even out as far as January to go beyond the inauguration day. February, to go beyond the inauguration day of January 20th. However, the market already knows what you know, and so does the market maker, meaning that those December, January, and February calls on the VIX and the puts on SPY and the puts on QQQ are heavily inflated because the concepts of this event that's going to affect the US and the US markets is pretty much, I'm not going to say already priced in, but there's a lot of pricing in because the market knows there's going to be some effect leading up to it and after it. I'm not saying it's not important to have a hedge. I'm saying it's likely to be expensive. And of course, this led to a follow-up on Maurice very quickly. He said, okay, well, let's assume I have a portfolio of $155,000 in equities. And as of today, I have SPY puts expiring 2/19. Pretty good, out to February. He's got the 325 strike. So how many puts do I have to buy to cover this portfolio? Okay, well, there's a webinar that describes that. We just covered it recently. And you don't look to hedge the entire loss. What do I mean by that? Let's say Maurice's $155,000 in equities is directly a beta of 1 to SPY. So if SPY drops another 10% going into the election, well, he stands to lose about $15,000, $15,500. You're not looking to protect against that full loss of $15,500. You're looking to protect half of that. So if the stock falls, if the equity portfolio falls 10%, you're only losing 5. Why? Because if I looked to hedge that entire portion, I'm going to have to buy a lot of puts and put a lot of money in, which means if I'm wrong and the market keeps going up, I've hedged myself out too much. I'm not getting any profit to the upside because the hedge for the fear that I thought was going to happen if the market did fall 10% is eating up all the profits. You're going to be too hedged. But in that webinar, Analyzing Hedges on Long Portfolio Exposures, just from a couple weeks ago on September 13th, what we do is we use a tool called the Long Option Finder, which allows you to put in your underlying security. So I'd put in SPY, QQQ, or IWM. Then I'd put in a price that was, say, 10% below the current price, and this would show me which option would give me the best return if the underlying did hit my fear price on my target date. Of course, if you're expecting or you're looking to analyze an inverse, you could just put the inverse in, put in a 10% increase, and it would show you which calls would be the best to buy if the stock hits your target expectation near your expectation date. Well, then what do? I now have this put that shows me what its gain would be if the stock or the underlying did hit my fear mark on my target date. I can see the monetary gain on that option. And then I can say, if I want to hedge half of a $15,000 loss, how many contracts do I need to buy to turn this purchase amount into a profit of $7,500 or $7,700? And there you've got the number of contracts that you want. Now, this presentation here, this 23-minute presentation that goes through that process, goes through using that tool, it's looking at the example of IWM for David's question, which was very similar. He had a large portion of stocks in a portfolio that were weighted to IWM. And we looked at that, or the Russell 2000, excuse me. So we looked at IWM as the example, but you would just take the same approach discussed in this presentation and apply it to SPY, and you would be all set in that case. That's how we would do it, Maurice. That's how you'd look at how much you want to hedge your portfolio, analyze how much you would lose in your portfolio, even if it's an options portfolio, if SPY drops another 5, 10, 15%. Then it'll show you which option would have the highest return if the stock fell to your target price by your target date. And then you can use the math to say, well, if I would have lost X on my portfolio, how many contracts do I need to buy to hedge half of that decline? So if a 10% decline occurs, I'm only down 5%. Okay. All right. So let me scroll through. We're going to pause for a moment. I know that we have those 4 main questions that came up, but I need to scroll through what's been going on since then. All right. So Sloan was a direct question. Okay. Don says, what kind of a return can you expect from such a portfolio? I've been averaging, honestly, close to 15%, 18%. The married puts themselves, typically, I see a gain of 10 or 12%. I do much better with the bull put credit spread of my portfolio, Don. And of course, the comment there is, well, why aren't you doing it more with bull puts? If bull puts are working better for you and have a higher return, why are you trading with married puts? Well, this goes back to another quick question, another quick comment that came in last week, a couple weeks ago. And a customer asked, if you could trade only one strategy for the rest of your life, what would it be? My answer was married puts. And he was shocked. Why would you do that? You already said that bull puts perform better, and sometimes you do better on your calendar spreads than you do on the bull puts. Why would you trade married puts? Because the question you're asking me is that if I could trade only one options position and something happened to me where I was incapacitated and I couldn't apply my management techniques to the bull puts, to the calendar spreads, to the earning straddles, which strategy would be the best? And it'd be the married puts, because if some reason I'm incapacitated for 3 months and the market falls 40%, I'm down 3%. If I'm incapacitated for 3 months and the market goes up 20, 25%, I'm going to be up 15, 17% on the married put portfolio. So you're not saying if I had the option to follow all of my trading rules and all of my trading techniques and the strategies that I use in my portfolio to manage and do all of those, which ones would you prefer? What you're asking is if I could only trade one thing and I wasn't able to do any follow-up or anything else after that, what would it be? It'd be the married puts for me without a question. That's for me personally. Okay. So that's where I'm going with that. And that kind of relates to the comment there as well. Against the return, the bull puts do better. But remember, in a moment like February 5th through 9th of 2018, The first volatility big spike that we saw with the trade wars in China, I had 3 bull puts open. And in an instant, the previous day, with only 4 days to expiration, they were all profitable, could be closed for a 10% return. That next day, they were all down 50%. My married puts were only down 2%. Okay, so that's why I don't trade 50% of my portfolio with bull puts. Proper position sizing, not low risk. They are known risk positions, but if you overtrade them, you're still going to get in trouble. William entered the slide where you showed adding to a naked put. There we go, right? Okay, adding to a naked put. For the long put that you would add, what delta would you look at and how far would you go? Okay, so William, what I'm talking about here is that if I'm in a naked put position, there's no one answer to this question, William, unfortunately, because it's going to depend on the situation. Let's say I did enter naked puts here. Let's say I entered them on SPY. We were at 355. I went 10 points below, and I sold a 345 put, and I started to get afraid here, even though it did touch 345. And you're asking me which delta would I use? Well, I wouldn't relate it on delta as more related to what strike did I sell. So if I had sold the 345 put and this started to fall and I wanted to limit my exposure, I'd probably just be buying the 340, the 343, a 342.5, maybe the next strike below or 2 strikes below. But that also depends on another factor, doesn't it? What I mean by that, William, is let's say that I only took in $3 for selling this 345 put. A naked put position, I thought the stock was going to stay up and my put would expire worthless at 345. Now the stock is falling and I say, okay, I'm going to buy the 343 strike. But now with a spike in volatility, fall in the stock, still maybe 18 days to go to expiration, this put is up to $5. Well, now I'd be in a bull put credit spread that I paid a debit. There's no chance for profit. I'm going to have to look for something that's maybe below that $3 I originally received for the naked put. So I might be going as far down as the 330, maybe the 325 to only pay $1. So there is some situation dependency upon which put you would buy to select on that. Okay, because it's after the fact. To be honest, in this situation, if I was still riding the wave and I thought this is going to continue up and I did sell that 345 put, let's say for today's expiration, when this happened, I would have tried to roll this down probably to October to maybe the 330. And okay, it came back up, was looking good. And oh no, here it comes again. So now I'm probably rolling out to the end of the October and I'm probably down to the 315, maybe the 320, then maybe adding another put. Okay, so I still have to manage this. I don't want to just leave that go. I was just saying if I've entered these positions, I'm a naked put trader, William. I've been trading naked puts, but now I'm a little bit worried about further exposure and volatility. I'm going to probably go further out of the money than I normally would with my search criteria. Then what I'm likely going to do is if I add that into the position, that lower strike put, I still have to make sure that I'm receiving the credit from the initial position, even though I'm alleviating, some of the exposure as well. I want to make sure I'm still getting a credit. So if the market does stay above where I want to, I want to make sure I'm still getting positive premium on the position. That's a little bit more situational, William, in that case. That was for our discussions for Don and Maurice.